This is a very timely panel. You've heard several well-respected individuals talk about the economy, the markets, interest rates specifically. And not surprisingly, there have been a variety of views presented, as well as a variety of actions to be taken as a result. Well, we have three panelists involved in portfolios where buy and sell decisions can, and in some cases must, be made based on what they see going on in the markets, what they hear from folks like our presenters, as well as many others. It comes down to their judgments based on all these inputs about what may happen subsequently in the economy, geopolitically, and by important actors such as the Fed. Data come in every day that can either be discounted or factored into decision making. They not only develop a view, but they have to act on it. Burl East is running our long-short real estate fund. Chip Montgomery is the head of strategy at Premium Point, one of our two managers in our long-short fixed income fund. And Kevin Schweitzer is the portfolio manager of Rockview, the other manager in our fixed income fund. I have to say this, and I probably have to do a disclaimer after I say it. Our long-short fixed income fund is the #1 performing non-traditional bond fund for the past year. And our real estate long-short fund is up 11% year to date. Now, past performance has nothing to do with future performance. Did you get that? Did you get that on the tape? Let's make sure that you did. We're very proud of what these folks have done. And you will notice I'm talking fixed income, long short, and real estate long short, both sides of the market. All three of these managers are looking at different sets of securities with different variables affecting their outcomes. But at the core, interest rates are critical. Burl is looking specifically at public real estate related companies. He brings over 30 years experience in the real estate industry as a very highly regarded analyst, a direct real estate investor, and as an investment manager. Chip has over 27 years of financial services experience with a focus on mortgage-backed securities in very senior roles in our industry. And Kevin has 25 years, it's hard to believe, 25 years experience in credits, and probably one of the longest histories of shorting credit in the industry. He founded Rockview in 2004 as a fundamental long-short credit strategy. These gentlemen will walk you through what they are doing right now, what they expect to be doing, and what they are focusing on to determine how they will respond in their portfolios. I'm going to set the stage with a couple of slides that focus on interest rates and what could happen. Not something you haven't seen before, but this may give you a little different perspective. I will then turn this over to the managers one by one, and hopefully we'll have some time for Q&A. I've collected a fair number of questions from the audience here already. These are practitioners, and I think their perspective is worth hearing. So let me start here. Let me go back. That's not the first slide I want to show. I want to show this slide, which none of you have ever seen before, right? My guess is half of the audience is thinking, if I see another slide of this 30-year bond bull market, I'm going to shoot the presenter. I think I've only seen it 3 times already today. Now, I hope you won't do that, because I would bet that you're going to see it a couple more times before these 2 days are over. It does make a point, though. We have had an unusual period of the wind at our back. We are not going to stay at this level forever, even if Jeff thinks that may very well be the case. And a return to normal, whatever that is, will involve a higher rate structure at some point. I did just post a blog on the Altegris website where I go into this a bit more, relating it to the ultimate determinant of rates, in my view, wages, and ultimately out of that, inflation. Take a look at this if you want to get a bit more esoteric about this topic. I did add a couple of other elements to this slide to make it a little bit different from what everybody else is putting up. I added a 5-year rolling average of the Fed funds rate. And I started the graph in 1955. That was for pretty specific reasons, not just to make it different from the standard 30-year bull. I'll end that sentence there. While we can't totally ignore longer histories, in my view, the modern world actually did start around 1955. That was the year that Raytheon manufactured 1 million integrated circuits. Moore's law, processing speeds doubling every 18 months, began taking effect then. That's a different world from the world that existed before. I use a 5-year rolling average because markets, in my view, markets and their participants seem to have about a 5-year memory span. Think about that. We are a few months past the 5-year anniversary of the Lehman bankruptcy, and performance charts are now starting to reflect that. This slide is simply there to let you know that rising rates are not the end of the world. Although you may have heard or will hear differently from some of our speakers. This shows that in periods when rates were rising over the last 25 years, there were fixed income strategies in hedge fund format that did have positive returns and outperformed straight bonds. I could show a similar graph for real estate. This third and the last of my slides shows what the Fed has done historically when wages started to rise and what they haven't done thus far. I believe wages and the resulting impact on inflation will ultimately lead to rate rises, and maybe on a different time frame from what you've heard from others here. Again, you can take a look at this blog if you want to get more specifics on this. The net is that at some point this will happen, and we need to be ready for it. I think these three managers are ready for it, as well as being able to operate in the current environment. So let me turn this over to them so you can hear from folks who deal with this every day. And as I said, we'll do about 10 minutes with each, and then hopefully some Q&A. So let me welcome Burl to the podium, to be followed by Chip and then Kevin. Careful, that's a thin ledge. This will just go falling out of your hand.
Thanks, Jack. And I want to thank Altegris for having me. My name is Burl East, and I'm the CEO of American Assets Capital Advisors. I have a couple of my colleagues in the audience. Say hi to them if you see them. Creed Murphy and Ernest Rady are here as well. I'm going to talk a little bit about what we do. Oh, it's on the other side, sorry. I'm going to talk about a little bit about our investment philosophy, our portfolio positioning, and then we're going to talk about kind of where we think we are in the interest rate cycle and some of the portfolio positioning relative to that. Jack, is it okay if I stand up there? My mic, can you hear me if I walk out here?
Yeah.
Okay, great. I frankly can't see this far. So standing here, I'm going, dude, I didn't bring my glasses. We run global, long-short real estate securities. This would include things like REITs and builders, gaming and lodging, real estate service companies, things like this. It is a huge space. It has 600 separate securities. This is just in the United States. Ballpark $1.5 trillion in cap. So it is a very, very, very big, very diverse, very dynamic space we happen to operate in. I've had a couple conversations with folks here who said, well, kind of how do you do this? What do you look for? We're looking for one fundamental thing, a frustrated or angry tenant. I'm looking for a situation where the conversation between the landlord and the tenant leads the tenant to be angry or frustrated about rent through denial of choice, meaning they cannot or they will not leave the building. That allows the landlord to maintain high occupancy and to raise rent. That is same-store NOI, which is, if it was McDonald's, that would be same-store sales. That is pricing power in our business. That's the primary thing we're looking for. That drives every single decision. That is most prevalent when these four characteristics pop up in our sequence. We have oligopoly, like there's a limited number of people that provide whatever piece of real estate it is. We have barriers to entry. It's hard to provide that real estate. And give you an example. Picture to the lower right is Marina Bay Sands. That's owned by Las Vegas Sands. It's a $5 billion casino and hotel operation. It's in Singapore. It's one of two assets in Singapore by license. So you have an oligopoly, a duopoly there. We're looking for barrier to exit for the tenant. Can the tenant leave if offered a choice? And the example I always tell people is next time you go to the dentist, ask your dentist how difficult it would be to move. After he removes the tools from your mouth, he or she removes the tools from your mouth, and stares around the building, is going to go, you know, we've got like $2 million of stuff bolted to the floor. We're not going anywhere. That's what we're looking for. And the last thing is secular demand. Is the tenant's business healthy? Currently, portfolio position, we're about, call it 130 long, 30 short. We think this continues for quite a while, probably to the end of this decade, with maybe some minor variances. But we're in inning, call it 3, of a 9-inning recovery in commercial real estate values in almost every property type in almost every part of the country. If this were not the Altegris conference, if this were the ULI, Urban Land Institute conference in 2 weeks, and I stood up here and I said, show of hands, how many of you think your business is getting better? I'd get 4,000 hands. How many of you think your business is getting worse? Nobody. So we're in a sustained recovery. Here's what's changed for us over the past kind of couple years. Occupancies are rising. Buildings which might have been 75 or 80% at the bottom of the cycle are now in the low 90s. Rents are up dramatically, both posted rent and street rent, which is kind of what's happening at the ground. And concessions are going down because there's a rent component to this. And then I'm going to give you some free stuff under the table component. And the free stuff is going down. And then cash flows have improved dramatically. So our stocks off the bottom have basically doubled. There is a battle going on in our space between growth and value, and this really reflects the conversations you've heard early in the day, which is which way is GNP going at the margin? Are we going into a 2% world or a 4% world? And mostly what I've heard today is a 2% world. And this drives, of course, rate expectations for us, as well as asset allocation at the margin. Because within our space, there's kind of 15 or 20 businesses, and some of them are much more cyclically sensitive, like lodging, for instance, and some of them would be less, like healthcare. And that determines sort of where we position capital. What we're looking for. We heard a lot about housing today. Housing punches way above its weight. If you're an economist at the Fed, housing is your best friend. Every house start creates 3 jobs. So if we're running 500,000 houses low, that's 1.5 million jobs. We don't ever get to 3 or 4% GNP without housing. You can't get there without housing. End of conversation. So if you're the Fed, you need to be accommodative. You also need to jawbone the financial industry into making loans to home buyers, which means, in theory, we're kind of going back to 2004 in terms of credit control and how you get a loan. Housing affordability, there's a small box there, kind of at the bottom there. Home prices, this is off the bottom, okay? Home prices are up 28%, and 30-year mortgages are up 38%. That doesn't mean it's 38%. It's gone from 3 to 4, okay? Meanwhile, though, a mortgage payment for the same house is up 50%. So the house is up, mortgage rates are up, the mortgage payment is way up. Now, in the old days, we would have merely accommodated that by making you a pick-a-pay loan at 50 bips, and you weren't paying any amortization, and everything was fine. We don't really do that anymore. So now a house that has a payment which is 50% greater needs an income that's 50% greater, and we clearly don't have that. Credit standards are about 7 times higher now than they were at the bottom of the cycle. We, amongst some of the other folks you might meet today, are probably less credit sensitive, less rate sensitive than your average manager. There's 4 pieces of information up here. I'm going to go through each one quickly. The first is that I'm a big fan of inflation and GNP. In the 20-year period that we've looked at, this is the upper left-hand scattergram, 72% of the time that GNP is growing, REITs, my primary vehicle, have positive total returns. So I'm happy with that. And usually rate and inflation are kind of tied at the hip. Lower left, I've got a CAGR of dividend growth of 8% a year going back to the Johnson administration, actually, the Kennedy administration. So I've got this long-term cash flow growth that powers kind of everything that we do. And if you look at the 2 recessions, which are the big whopping recessions, which would be the '74 recession and the Great Recession, you have a decline in cash flow. But the normal recessions, the ones in between, it just goes sideways. Upper right, rolling dividend yields on our stocks almost always exceed inflation, and usually by 200 to 400 basis points. So when you start at 6, we were talking about how you'd race Clowney in a foot race. By the way, Jimmy Fallon did this on TV, and you might want to look that up because it's pretty funny. He's not very fast. But he needs to start at the 50. This is us starting at the 50. When you start with 200 to 400 basis points of positive incremental yield over inflation, it just frankly makes life easier. And then the slide to the lower right, this is the most important of the graphs. This is what we pretty much end every presentation with, is we're back to 0. Our stocks are up 50% off the bottom, but we're back to 0. And from 0, the last 3 cycles, returns have been sort of 3 to 5x. Real estate, the business we're in, is a very slow-moving business. If some of you aren't from here, perhaps you'll have a chance to go to the beach. And while you're at the beach, I would ask that you observe the tide and not the waves. The waves happen very quickly, 1,000, 2 1,000, they land and they go out. But a tide takes about 12 hours. A tide moves at 3 to 4 knots, and a tide pushes a supertanker. A wave doesn't. We're in a tidal business, and real estate's about a 7, 8, 9, 10-year tide, and we're in inning 2 or 3. So while we've recovered back to 0, we're a long way from where we think we're going to be, and that affects our portfolio positioning, which is, again, net bias long, and will probably continue to be biased long through the end of this decade. And Jack, that's the end of my prepared remarks.
Great.